Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. As you all know, we've been talking about the possibility of corn futures turning to the upside, when one of the bases for that potential was the upside-down head and shoulders pattern that we saw materializing. In addition to that, the market was also making successive higher lows, which led us to believe that potential strength could very well be in the wings. The market made a couple of attempts near the 380 mark to penetrate, but failed at each of those attempts. This most recent attempt finally broke through, and one of the things that we actually wanted to show you this week was the way in which we wanted to forecast the probability of a big energetic move occurring somewhere near the June 6th timeline. One technique for being able to figure out when a long consolidation may terminate is to use the length of either a big decline or a big advance prior, and using that length by way of a properly scaled chart to tell us where that move may terminate. That's what we did here when we took the length of this move to the downside. And what we effectively did is we used this as a radial arm of a circle, and then we swung this arm all the way across to the 3 o'clock position. And in doing so, the line that was formed here told us that on about June 6th, that this consolidation had the potential for terminating. As we can see from the chart now, that prediction actually came through really well, with the market making a very big move to the upside yesterday and having additional follow through today, breaking through that 380 mark that has long been holding the market under. And now the market looks very well poised, or very well positioned at least, to potentially make a run at the 390 to 400 target threshold that we talked about months ago. After the move today, July corn is now bumping up against 2 bands of volatility-based resistance. One band rests in the area of 390 to 395 half, and the other area rests in the area of 384 to 390. We have a bit of overlap right up against that 390 number, and this is where we anticipate that our first line of potential resistance was going to rest. The market came up, and we can see that it has now touched our volatility-based resistance band. We also have an N-band demarcation here, and so the possibility of a sideways movement over the next couple of days is very well possible. But we also have a caveat where, because of the strength of the move that we've seen over the course of the last couple of days, some short squeezes may come into play by way of managed money, continuing to help support prices, and we could get to that 400 mark before the 13th that we've been looking for. The December contract is very similar in nature, where it had sequential higher lows as well. And after this third higher low, if you recall from our previous sessions, we talked about how when a market posts 4 sequential higher lows, that a big move to the upside is probable. That is exactly what we're now seeing, with this market making a very nice move upwards to about 405 or so in the movement that we're seeing right now. We have overhead resistance at 409 and a quarter, which is 1 standard deviation above the point of control. But it also does bear mentioning that in a similar fashion to what we did with the radial arm on the previous contract, we can see how when the market came in here, we had May 22nd for potential turn point date, which coincides very close to this low that we saw the market came in within a couple days. And then from there, we have our next radial date coming in on June 10th, which tells us that this market may in fact come into a pause over the next couple days, or right up into this timeline, and could very well find resistance somewhere close to about 407 to 408. Volatility-based resistance does not overlap for the December contract, but what we are seeing here is that the market is hitting up against our 90-degree mark of 402 half, and once again that 402 half is giving us resistance as would be anticipated when it hit it previously several months ago. We are also up against our end band, which tells us again that the market could very well find a pause here. But again, that caveat that we mentioned before with the potential for a short squeeze still exists, so we could still see some follow through to the upside for this contract. In an effort to forecast some potential turn dates for the soybean contract, instead of using the radial arm, we use a technique here that we call using a signature high or signature low. On January 18th of this year, the soybean contract made a very significant high. Using the price of that high, what we then did is we spun out that price in cycle fractals over the course of time to project for us future potential turn dates. Here we found that on February 23rd, the market did make a turn, which is not reflected in this particular chart. But on the next day, we also saw the market dropped into that March 26th timeline, where the market had fallen and then went sideways after that date. The next timeline came in on May 7th, where the market really made a nice topping formation and then eventually turned back down. And our next one that's coming up then sits on June 11th. So at this point, we would anticipate that the market would continue to potentially climb up near that June 11th date. And from there, we can see the next leg down for this particular contract. Additionally, we had talked about how the market was coming down up against our 1-by-1 price per time unit line, which is this red angle just below the market. And as would be expected, we found very good support against this area. The market consolidated against this level about 4 times and then was able to make a small bounce up from that level. From here, we can also see that the market was oversold. It's now making a nice move to the upside, but the strength at which it's making its advance is not nearly as strong as the strength with which it declined. Over the last 7 trading days, you can see that the price advance pales in comparison to what it did the previous 7 days, which tells us that we have the notion of overbalance here, and once price gets to a good spot of resistance, we should anticipate a nice move to the downside once again. Right now, soybean appears to be riding the coattails of corn a bit, but in the grand scheme of things, we believe that this market is probably due for continued weakness given the nature of how the price chart has been forming itself out. The lows that were made last week also did coincide with our sinusoidal wave support level, and the market made its way up and is now above that 180-degree mark of 921 3/4. And now we find ourselves in a position where we're bumping up against resistance at 932 to 945. This market then looks to perhaps pause somewhere in between this region, and then from there looks to turn back down again, or at the very least simply move in a consolidated fashion and simply move sideways from here. The price action in the November contract is very similar. Here we had our forecasted potential turn date come in on June 3rd. And on June 3rd, you can see the market really made a nice low coming into this timeline in conjunction with being oversold, and from there has made a nice advance. The market is bumping up against resistance now. Its first line of resistance sits at about 938, and the next line above that would be right at about 950 in the event that it's able to make it up that high. That 950 mark coincides with our 135-degree angle here for this chart. But as you can see, the market is bumping up against volatility-based resistance, which tells us that it's going to have a tough time getting through here. So the notion of getting to 950 is perhaps not that easy. Also, as we can see from the chart here, is the market had a very nice move to the upside intraday, but has given up most of the move and will close in the bottom third of the trading range of the day. That is not an indication of strength for the chart itself. And if we get a seller's bar or a bar that breaks below today's low, we would anticipate some continued weakness from here. Lastly, we can also see here on the November contract that the sinusoidal wave posed very good support as well when the market made its way down. So from here, that wave also coincides with the 45-degree mark. So moving up 90 degrees from there would give us very good resistance at that 949 to 950 area. July wheat's finally getting the bump that we anticipated that it might make. After making that significant low back in April, it has since made a couple sequential higher lows. This most recent low came in and retested that 422 number, and really that market barely touched it and came back up and had a very strong reversal bar on that move. From there, the market continued higher, and now we can see a very nice breakout to the upside for this movement. In addition to that, we're looking at about June 14th as the opportunity for this market to pause on the way up. And that looks to coincide with the market being overbought near that timeline as well if it continues higher. The move over the last 2 or 3 days have been pretty strong, and today's resistance can be found right up against a point of control level of 448.25. So from here, if the market's able to make it above this 448.25 number, we could very well see a market that moves up to potentially retest the previous high of 461.5. But somewhere in between here is where we look for the market to find near-term resistance. From this vantage point, we can see how we finally were able to get past that 441 key level that we discussed in the past. Yesterday, the market came up and just basically touched it, and today was finally able to break through. Overhead resistance now, in terms of the volatility-based resistance band, sits at 455 to 465. So from here, we'd be looking to see whether or not the market's able to get past this 451 number with one more day left before the week closes out. The December contract movement is very similar in nature with sequential higher lows as well. In fact, as we look at this movement here, like the previous contract, we're sitting right up against the point of control of 482.5, and this is specifically where we find good resistance for this particular contract. Above 482.5, look for continued strength. A quick recap of how the signature higher low technique worked for this contract. We can see that on March 19th, the market picked out a perfect high. From there, we found another low on April 9th. The next point was on May 25th, and we found ourselves with a minor high inside of this sideways movement. And the next level then that we're looking at is potentially on June 9th. Volatility-based resistance overhead rests in the neighborhood of 487.5 to 497. And so this is where we anticipate the market finding very good resistance in the event that it's able to get through its current point of control level. You saw again here how the market was able to get through this 90-degree level at 475.5. And upon breaking through here is where we were finally able to get some good strength. So right now we're looking for this contract to come up and meet volatility-based resistance overhead, where it looks to perhaps be stopped in its tracks at the 180-degree mark at 496.5. The December cotton contract continues to hover up against that 72.27 number and continues to keep bouncing right up against this area. As we can see here, we actually have a potential turn demarcation of June 5th, where the market came down into this move, and today we're seeing a nice little bounce to the upside, however small as it might be. Even with the potential of a turn opportunity to the upside, the overall picture of the chart continues to look weak though, giving us a pennant formation where if the market were to break down below this 2720 number that we've talked about in the past, would indicate that the market would potentially drop down to about 7160 or 7135 or so. Depending on how this market's able to move from this area is going to be key, but for now the market is oversold. Although it is sideways and losing a bit of energy, we want to stand down until the market gives us a clear indication of direction. The crude oil contracts giving us exactly what we've been looking for. We saw a small consolidation up against support for a couple of days, and today the market has returned to weakness and is now well poised to reach that target that we've been looking for, somewhere in the neighborhood of 44.76 to 44.12. Thank you so much for joining us for our weekly market update, and look forward to touching base with you again next week.